It's difficult for me right now to see portfolios that don't have 10% precious metals and precious metals equities. I consider the alternatives available to me in a circumstance with artificially low interest rates coming off a 10-year economic expansion. I think the risks of not having a 10% exposure to precious metals are much higher than the risks of having a 10% precious metals exposure. I wouldn't argue with certain investors having a 20% exposure to precious metals and precious metals securities, understanding that the insurance part of owning precious metals, which is to say owning physical precious metals to maintain rather than increase somebody's purchasing power, is extremely efficient. When you're in a gold bull market, gold does so well that holding a little bit of gold insures a lot of the rest of your portfolio. With regard to the broader natural resources segment, which goes to the first part of the questioner's question, combining gold and, well, let's say precious metals with the rest of resources, depending on your time frame and depending on your means, it wouldn't hurt my feelings, as depressed as commodities are in the historic sense. And given the anemic returns, negative real interest rate returns on other forms of investments, I don't discourage holdings in the broader natural resource portfolios of up to 30%, with the caveat that when resources return to favor, and this 30% has, of its own volition, doubled to 60 or 65% of your portfolio. In other words, perversely, when you're feeling smart about the decision and you love natural resources and precious metals, begin to sell some. When you feel good about it, take it down.
Welcome back to Liberty and Finance. We're delighted to have this returning guest. Rick Rule joins us this Monday, December 7th, 2020. Rick, thank you for joining us again on the show.
Donegan, it's always a pleasure. Thank you for having me back.
Our viewers often request, where is Rick? And it's been too long since we've had you on, so delighted that you could work us into your schedule. There's been a lot of questions submitted ahead of your visit, but before we get to those, we hoped you could give us your, as close as we can get to a year in review of the year 2020, specifically from a economic, financial, and precious metals / natural resources investing standpoint. There's been a lot going on. You've visited us a few times since the Sprott Natural Resource Symposium, but as fourth quarter is winding to a close here, what are the latest observations that you've made that you think are worthy of our viewers being aware of?
Well, the parable from the fairy tale, not too hot, not too cold, just right, describes certainly precious metals markets for 2020. Recovery from oversold bottom, solidly into a bull market, got way ahead of ourselves in the middle part of the year, particularly with the junior stocks. And then we had the junior stocks sell off, so that we're beginning to see some fairly compelling opportunities there. So I would say that the market, from my point of view, is perfect. There's skepticism in the market now, which is always healthy. Bull markets climb a wall of worry. And we've certainly seen in the last 2 or 3 months, with the flattening in precious metals prices and the precipitous decline in what was a very overpriced junior class, a wall of worry, which is a wonderful set of circumstances. I never have anything good to say about politics. So I'll probably leave that aside for fear of disenfranchising both Democrats and Republicans simultaneously. I can only say that while the politics we're experiencing in the United States are very bad for the United States, they're very good for precious metals. The factors that we discussed at the beginning of the year on your show, I remember this discussion well, were that precious metals and precious metals equities did well in circumstances where people were concerned about the purchasing power of their savings. And this is a year that's done nothing to reinforce people's confidence in the purchasing power of their savings, to recite quantitative easing. As we said then, we said today, if you did it, it would be called counterfeiting. If a congressman does it, it's policy. He or she is popular and they get reelected. Not going away, it's going to increase. Debt and deficits. What can one say? We owe each other and other bondholders at the federal level something like $170 trillion. And that number seems to grow by $3 or $5 trillion a year. If that doesn't concern you about the efficacy of your savings, nothing will. But worse, you don't get paid to save. Negative interest rates, we've said it before. Negative interest rates equate to return-free risk. So gold has to compete with return-free risk. Even I can compete with return-free risk. And then there's scarcity. Precious metals and precious metals related assets continue to comprise less than 0.5% of the total savings and investment assets in the United States, as against a 3-decade median and mean of 1.5% to 2%. This is an extremely constructive environment for precious metals and precious metals equities. So if that's the case, people say, why did they go down? If one examines the 2 prior bull markets in my lifetime, what you'll find is that retrenchments of between 10 and 25% in the equities indexes happen with the ease and frequency, Dunnigan, that you and I inhale and exhale. And if people don't understand that cyclical declines in a secular bull market are part of the game, they belong in a different game. They belong in return-free risk. This is a very, very, very healthy market.
When we've seen new record highs being set on a recurring basis on the equity indexes, I guess that's what part of one of the side effects of what you're talking about in terms of expansion of the currency supply. Could you weigh in on that briefly?
Well, let me say that I'm not agnostic as to the broad U.S. stock market. While the valuations of many companies exceed my willingness to pay for them, that might have to do with the fact that I'm not well informed as to how to decide what they're worth. So I'm not going to weigh in, like many of your commentators do, as to whether the broad U.S. equity markets is underpriced or overpriced. My suspicion is that it's overpriced for 2 reasons. Corporate America's cost of capital is artificially low because of artificially low interest rates, and their dividend yields are priced artificially strongly because of artificially low interest rates. I'm not one of those who says the world is coming to an end. Sell all your general market securities and just buy gold. That's stupid. Pick and choose your spots. But understand that with regards to bonds, we've been in a 38-year bull market. With regards to general equities, we've been in a 35-year bull market. Those things usually require a respite. I'm not trying to say it has to happen, but it usually does happen. And with regards to gold, we're much earlier in a gold bull market. Both gold and equities, when I say gold, I'm using that as a subject, a catch-all subject for precious metals and precious metals equities, have a place in every portfolio. One fear I do have in the intermediate term, in terms of gold's gaining enough popularity that its market share increases, is the sense that some people have that the purchasing power of their savings can be protected in general equity ETFs. Some people seem to believe that general equities can grow to the moon, the sort of Jack and the Beanstalk analogy. And I suspect that if, in terms of adherence, gold had something to fear, it has more to fear from general equities ETFs than it does, as an example, from Bitcoin, simply because the general equities ETFs have much broader acceptance and a much, much, much broader market share.
I did want to ask you about Bitcoin in general. Again, I'll use that as a blanket term, as you were using gold as a blanket term for cryptocurrencies in general, or I guess digital dollar alternatives, because in the last month we've seen this flourishing emergence of a narrative about Bitcoin is the new gold, or Bitcoin is gold 2.0, and get with the right side of history going forward, and that sort of thing. Some pretty big names and even some investment banks and so on coming out with this narrative. You typically are a credit analyst on companies that deal with real things and real assets. So what's your take on this latest narrative that's come out about Bitcoin being the new gold?
Well, that's a huge question. I'll try and unpack it. In terms of Bitcoin being the new gold, that's silly. It's just silly. They are not competing asset classes. They're cooperating asset classes, competing perhaps at the wildest fringe, which is to say the Robin Hood buyer. But they fulfill different functions. Gold is, at its heart, a medium of exchange that's simultaneously a store of value. It's durable, it's malleable, it's divisible. It has value separate and apart from a transactional medium. Bitcoin started off, and its utility was as a frictionless transactional media that didn't require any trust. In which case it's absolutely a wonderful piece of technology. The problem with it, if it has a problem in terms of its ability to compete with gold, is that it isn't intrinsically a store of value. The value comes in its anonymity and in the size of the network. Its problem, perversely, is that the price performance, which has attracted speculators, obviates its value as a medium of exchange. Its volatility is so high that it no longer can function as a medium of exchange. Somebody who uses Bitcoin to buy something from somebody doesn't know what they paid. Somebody who got paid doesn't know what they received. There isn't enough ubiquity in Bitcoin transactions that Bitcoin itself can set prices. It's a mechanism to respond to prices that are set in fiat currencies, much as gold is. The difficulty is that the volatility is so extraordinary, even related to gold, that it is using up its volatility as a medium of exchange. It is confining itself right now to two functions, one of which does compete with gold, which is to say government insurance. It is potentially a medium of exchange as a consequence of its network that doesn't rely on third-party trust because the trust is in the network itself, and has anonymity attached to it. What it fails to have is value in and of itself outside of the network. What it does have that gold doesn't have is potentially almost frictionless transference. My own interest in the technology continues to be utilizing the blockchain and the distributed ledger to create digital forms of exchange that are in effect gold denominated, combining the best of both worlds. I'm not anti-Bitcoin. I'm very, very, very pro-Bitcoin, although I no longer own any. I don't see it as a competitor to gold, except in the extraordinary fringes of demand for both.
I'd like to follow this vein just a little bit farther. Menachem Saler says, Rick, how do you consider the potential for the obsolescence of gold and silver as sound financial holdings? You often emphasize historic allocation to precious metals and related investments and expect a mean reversion. You talked about that a few minutes ago. By that logic, why wouldn't any other obsolete commodity such as whale oil be likewise due for a very sharp mean reversion in demand and consequent price spike?
The gentleman needs to refresh himself with the works of Aristotle, who preceded rule fairly substantially.
Same gold, caliber, though. Yeah, okay.
Gold has been regarded positively, going back thousands of years in cultures that were very disparate from each other, because of its luster and beauty, because of its use in religious iconography. Nobody ever created an icon to whale oil. Mm-hmm. Gold is also durable. Storing whale oil would give you an immediate or almost immediate and smelly lesson in durability. Gold is consistent. 24 karat gold is 24 karat gold is 24 karat gold. But I suspect that there are qualitative differences in whale oil obtained from a blue whale or a sperm whale. Gold is a commonly accepted medium of exchange, and whale oil was used to light lamps. I realized that the gentleman was trying to make a point and was facetious, but the point he chose was similarly facetious. Looking back 2 or 3 or 4 or 5,000 years, it's interesting that gold arose as a store of value and a medium of exchange in cultures that had no ostensible or documented relationship with each other. Mesoamerica, East Asia, South Asia, Eurasia, Africa. Now, I realize that separate and apart from its use as jewelry and iconography, some part of the store of value and hence the utility as a medium of exchange is almost faith-based. What I can say is the fact that that faith and the appreciation of gold as a medium of exchange arose simultaneously in cultures that had no connection to each other, so it wasn't enforced, and has also been extraordinarily durable. Durable unlike any other medium of exchange in human history. Could you use something else that was rare and valuable? Well, diamonds, except for that you shouldn't auto-divide them. And there are lots of differences in classification. Gold is almost unique in simultaneously being a store of value or rather than a medium of exchange. So my suggestion, pardon me, is that although there is a possibility that what the gentleman suggests is true, the possibility is vanishingly small relative to the probability that gold will continue to form a place as a store of value. Should it be 100% of somebody's portfolio? No. But the absence of ownership is riskier than ownership.
If we could press just a little bit farther on the other topic of cryptocurrencies, there's an anticipation, at least fairly broadly across the financial analyst space, that central banks will in some form roll out official cryptocurrencies to hopefully supplant these kind of grassroots ones that have sprung up. Carolina Contracting says, after the central banks roll out their digital currencies and crypto undergoes regulation, when people realize the loss of anonymity, do you think precious metals will get a boost?
Yes. And by the way, crypto counterfeiting is even cheaper than physical counterfeiting. So for central governments, cryptocurrencies are a real boom. First of all, you can create this stuff at absolutely no cost at all. No paper to buy, no ink, no design, just the stroke of a key. But more to the questioner's point, the government will no longer have to worry about tracking your savings and tracking your spending for tax purposes. That'll be taken care of by the system. One of the chief joys of cryptocurrency has always been the fact that you don't have to trust a third party, and particularly your government, which is, of course, according to my point of view, never trustworthy. But in addition, the anonymity will be obviated by having the system not peer operated, but rather operated by the entity that I consider to be the enemy.
We have a question about turning our attention to investments versus speculation. Yusip Yacht says, when Rick says he has an investment portfolio and a speculative portfolio, what does he mean by investments? Are these things like senior gold miners and royalty companies that are less risky than explorers? Or is he talking about non-precious metal equities altogether?
I consider the investment process, meaning acquiring securities with the probability of an acceptable rate of return. I regard speculating is accepting possible rather than probable returns that are in excess of the returns available on less risky securities. I enjoy both processes, and as I become old, I have to admit that I have become more cautious in my advice to others. It should be noted that all of the money that I now invest prudently on my own behalf, I made speculating wildly. So there's a little dichotomy in place. And I continue to believe that if you believe with regards to precious metals, what I believe that judicious investments in the bigger royalty and streaming companies and some of the large operating companies involve the probability of acceptable rates of return on capital employed and therefore qualify from my point of view as investments. Much of what I do involves a possibility as compared to a probability, but offer returns that are historically substantially above market and have always been of interest to me. Similarly, I invest in equities outside of natural resources and precious metals where I think the probabilities are strong enough that they can overcome the doubt I have in my own analytical abilities in industries that I have less experience with than natural resources and precious metals.
On the same thread here, Jonathan Stringer asks, Rick, I've heard you mention in the past that you are more open than most to investing in precious metals miners that are based in areas typically considered to be more, quote, politically risky. Why is that? And any thoughts on where Peru is headed after 3 presidents in a week? Okay, one at a time. Are you, in fact, more open than most to investing in precious metals in quote-unquote risky, politically risky areas, and why is that?
I am, and I'm more open than most for negative reasons, which is to say that I believe all jurisdictions are risky. Many investors believe that money stolen from you by government, where the government is Caucasian and male, speaks English, and steals from you according to the rule of law, is less gone than government theft or private theft that occurs more efficiently in frontier markets. The worst experience of political risk of my career occurred in the People's Republic of California in 1981, where net present value approximating $700 million was stolen from shareholders by the legislature of the state of California. And they had the temerity to call Congo risky. So I'm not suggesting to you that these frontier markets aren't risky. I'm suggesting to you that the mature markets that you feel so good about, because your peers steal the money from you, are less risky. I would prefer an asset that was considered to be attractive enough to steal, rather than an asset that nobody in a first world country or a third world country would bother themselves with. The idea that people will pursue a tier 3 asset in a jurisdiction that they feel comfortable with rather than a tier 1 asset where the theft occurs by less regular means is something that I've never understood. With regards to Peru, I think in the near term, it is a fairly risky jurisdiction. The political uncertainty that you have in place will give rise to popular governments, which means in the very near term that the incentive to steal fixed assets, which is to say to increase the social expenditure and the social rents on mining, will increase rather than decrease. Over time, Peru has a lot of advantages. It is a very fertile geological terrain, which means there's lots of good stuff to discover. Relative to many of its peers, it has extraordinary human resources in the natural resources business. And I don't just mean at the mine face. It has excellent managers. It has some good regulators. They have a financial services infrastructure in place. And they have relatively good infrastructure with regards to mining. So although I accept the fact that there are going to be some fairly dramatic hiccups in Peru for the next 18 months, I will continue to invest in Peru where given the correct incentive.
We've had a number of analysts on our show talking about strains in the banking industry and in the fiat currency system itself. And this question from a viewer pokes, I think, at the consequences on an ordinary person of risk in their currency. Lee Na says, what must a shareholder expect when it happens that his shares are traded in euros in case the euro would collapse and be non-existent? For example, mining shares from a Canadian company traded in the euro. How should one deal with these risks today?
Well, I think there are risks there. I don't think that they're high on the list of risks that you need to consider. My belief is that the major currencies that we deal in will remain intact for longer than many people believe. While the strains are in place from an arithmetic point of view, from a social point of view, the wish for trust in governments, in central banks, and in currencies is very strong. And so I believe that the currencies will continue to exist for much longer than we suspect that they should arithmetically. Similarly, there is a broad wish on the part of voters and a broad hope on the part of voters that the systems that we live under continue, which means, as an example, were there to be the collapse of a bank, say Deutsche Bank, the idea that the European community would paper over the collapse, nationalize the bank, and plug the hole of the disappearing assets from the bank with quantitatively eased fake euros, I believe they'd get away with it. With regards to the US banking system, absent an exogenous shock from a repeat of the 2008 mortgage crisis as an example, or a bit more worryingly, liquidity crisis in over-the-counter derivatives, the United States banking industry is substantially better capitalized with regards to Tier 1 capital than it was going into the 2008 crisis. I'm not trying to say that we aren't without risk, but I am trying to say that, as an example, credit card issuances, mortgage approvals, and loan-to-value ratios, certainly on prime rate loans in the U.S. banking system, are way improved relative to where they were 2008. Are there risks in place? Of course there are risks in place, but those aren't the principal risks that investors and speculators need to be concerned about in the mining business.
We have a question here about investing in the mining business. Jenna Morehart says, if past is prologue, would optionality on silver mines to be, or near-term, mid-tier producers give me the most robust returns? My strategy is 2 to 3 years hold on gold and silver miners, then trade in for uranium miners, and then juniors, and another 2 to 3 years hold. Thoughts on this strategy?
Optionality brings a smile to my face, because in the 1990s, early 1990s, nobody cared about optionality. Nobody believed we were ever going to see higher metal prices. And the consequence of that is that things that started off as optionality plays, like Silver Standard and Pan American Silver, went from under $1 to over $40 respectively, with me holding them, better yet. Optionality is no longer free. And the very success of the optionality strategy in the 90s has made it a very popular strategy today. So the problem with optionality is it's often overpriced. Does it work? In a red hot bull market, it works extremely well. But remember, I began that work with that word with if. I suspect that if you believe that silver and silver equities are going to do well, that you need to structure for yourself a balanced portfolio. You need the majority of your portfolio in stocks that will do very well, if not extraordinarily well, in the event of a dramatic repricing of silver. Well, if you have money that you're willing to lose half of in hopes of 15 and 20 to 1 returns, you constrain your optionality portfolio to really that amount of money which you're willing to risk 50% of if you are wrong. In other words, optionality, but only in its place as a consequence of the fact that it is no longer cheap. Remember this too. We often get too greedy. All of us, myself included. I'm not lecturing anybody. I can describe this sin because I'm so guilty of it. If you look at past precious metals bull markets, and particular past silver markets, an index constructed of the best producers in the sector will give you extraordinary returns. In terms of generating extraordinary returns, there's actually no need to outperform the index because the index itself performs extraordinarily well. If you want to, that is, if you want to take the extra risk, or if you just want the excitement, by all means do it. But please understand that the silver market is so volatile to the upside that if you constructed a portfolio of the 8 to 10 best silver miners in the world, if you got the type of silver market that I suspect we're going to get over the next 5 years, and you weren't satisfied with the result, you need be described as almost delusionally greedy. I'm not saying with some portion of your silver portfolio that you shouldn't take a speculative risk on optionality. The difficulty of putting too much of your portfolio in optionality is that individual corporate failure deprives you, ironically, of some of the result that you would get from better companies. So employ optionality if you want, but in moderation relative to making sure that you participate in the market.
Aside from precious metals, we have a question here on other resources. Aerarium Stabulum says, what does Rick Rule think of tin and aluminum as the world moves towards a new green economy?
I don't know enough about aluminum to comment, so I'm going to stay out of there. I'm extremely bullish about the tin market. I'm really, really bullish about the tin markets. Supply is constrained at the same time that we haven't explored for it for 20 years, which means that there are impending shortages in tin almost no matter what we do. And the utility of tin, that is the new applications for tin in various fabrication technologies, including distributed storage and power, are burgeoning. So I'm very attracted to the tin business. Understand that it's a small market and it will be extremely volatile. And if the market for tin doubles and people get attracted to it as a consequence of its price doubling, it could easily fall by 50 or 60% right afterwards. And the people that didn't have the guts to stay the trade through that cyclical decline would find themselves shaken out of a bull market. The volatility that you will experience in the tin market will make you feel, like a bull rider at a rodeo, not a calf roper. That's going to happen, to be sure, but I'm extremely bullish about the tin market.
This last question takes a completely different approach. Ride the Curve says, what occupations in the mining industry would you say are the most short in supply? Asking for a college-age friend looking for good career choices. For example, mining geologists, engineers, subcontractors, various types, core drilling specialists, etc.
I don't know the answer to that. God, I'm forced to sound like a really wise old sage, unfortunately, and not answer the question, but rather say the part of the mining business that fascinated you so much that you could outcompete any of your peers because trying hard would be an amusement for you. Partially that's because I don't know the first part to the question. Mm-hmm. Secondly, because I've competed with countless investors and countless analysts and beat most of them, simply because they didn't do it out of love, they did it to get a paycheck. And I never, I haven't had to worry about a paycheck for many years. It's difficult for people to compete with me because I get up wanting to go to work and I leave work grudgingly to go home. To the extent that people can put themselves in a role that they enjoy as much as the way I enjoy my role, it's going to be very, very difficult for other folks to compete with them.
Maybe we'll give you one more chance here then with Steve Schrum, who says, and I know this is a question that you're going to preface by saying it depends on the individual, it depends on their means, it depends on their needs and everything, but we just could benefit from your philosophy. What percent of one's portfolio would you recommend on balanced resource portfolio? For example, precious metals, oil, base metals, uranium. Also, what percent resources versus the rest of one's portfolio?
I won't deal with the last part of it. It's difficult for me right now to see portfolios that don't have 10% precious metals and precious metals equities. I consider the alternatives available to me in a circumstance with artificially low interest rates coming off a 10-year economic expansion. I think the risks of not having a 10% exposure to precious metals are much higher than the risks of having a 10% precious metals exposure. I wouldn't argue with certain investors having a 20% exposure to precious metals and precious metals securities, understanding that the insurance part of owning precious metals, which is to say owning physical precious metals to maintain rather than increase somebody's purchasing power, is extremely efficient. When you're in a gold bull market, gold does so well that holding a little bit of gold insures a lot of the rest of your portfolio. With regard to the broader natural resources segment, which goes to the first part of the questioner's question, combining gold and, well, let's say precious metals with the rest of resources, depending on your time frame and depending on your means, it wouldn't hurt my feelings, as depressed as commodities are in the historic sense. And given the anemic returns, negative real interest rate returns on other forms of investments, I don't discourage holdings in the broader natural resource portfolios of up to 30%, with the caveat that when resources return to favor and this 30% has, of its own volition, doubled to 60 or 65% of your portfolio. In other words, perversely, when you're feeling smart about the decision and you love natural resources and precious metals, begin to sell some. When you feel good about it, take it down.
Yeah, that's I guess sage advice on regardless of the type of equity that you're holding. That goes across any genre of that. Well, that wraps up the viewers' questions that we have time to present to you today. Could you give us a look ahead to 2021 and what are the main things that you're watching for as we enter that new era?
The first will be volatility. I noticed that the VIX has subsided substantially in the next 3 months, and my suspicion is that the VIX, which is the volatility index, will assert itself again. There are too many conflicting factors in the market for the market to be as tranquil as it has been. I expect bipartisan support in Congress for both quantitative easing and rather dramatic public spending. I don't think you'll see anything like checks to individuals because individuals don't lobby well enough. I suspect that you'll see enormous bailouts of large interest groups. And I suspect, unfortunately, that this will be very good for precious metals and very, very bad for the country. I don't know when all this will take place, but my suspicion is that the writing is on the wall for that. My hope is that we return to the circumstance that we had in the early part of 2020 with regards to precious metals equities markets, which is to say a stock picker's market rather than a narrative market. The narrative market that we moved into in midsummer 2020 was extremely unhealthy, where we had a melt up in the juniors, particularly the lame, the halt, and the blind part of the juniors. My hope is that the bad companies go broke, which probably won't happen, and that the good companies prosper. I continue to be concerned, with the caveat that I'm not an economist, that our economy benefited, if you will, from a 10-year long recovery from the 2008 collapse. And in my life, a 10-year long recovery was very long. We didn't have a chance to deflate that bubble gradually because we deflated it with COVID. Now we appear to be in a COVID recovery. I am concerned that the economy needs to digest a 10-year recovery that occurred as a consequence of artificially low interest rates And we need to digest the effect of the COVID on the economy, vaccines notwithstanding. I'm delighted that thus far the economy seems to be humming along with relative strength. That delight is tempered by the fact that my fear is that the reason that the economy is humming along has been the liquidity that stems from government-sanctioned counterfeiting. Nuanced and probably too soft a response, but that's the best I could work up in the circumstance.
Well, the only, I think, thing that I had any qualms about was you saying that the economy is humming along. We certainly are seeing areas of subsidized or circumstantially beneficial segments of the economy, but it seems like there are broad segments of the economy that are definitely struggling, and certainly people with unemployment that hasn't maybe all sunk in on everybody if they've had 6 months of unemployment benefits or something that are now going to be expiring, that sort of thing.
I think a fair enough comment, and the other shoe may drop. We've had mortgage forbearance. Mm-hmm. We have had eviction forbearance. We have had a lot of factors in this economy which haven't taken hold, which are probably temporary rather than permanent. And my response may stem partly from the fact that I'm old, fat, bald, rich, sequestered, and living in Northwest Washington, which is a consequence of things like Amazon and Microsoft and Starbucks and Costco, is artificially strong relative to the rest of the country. So I certainly hear and accept your counterpoint.
Yeah. We've been delighted to have your company here on Liberty and Finance. We've been speaking with Rick Rule, the CEO of Sprott Asset Management. Rick, before we let you go, do you want to re-up your offer to rank people's natural resource portfolios?
I love the opportunity to do that, Dunnigan. Thank you. The offer specifically is I've enjoyed visiting with your listeners and subscribers for a very long time, and I like to encourage them to engage in discussion. It seems the best way I can do that is to offer them a benefit, which is as follows. Anybody who goes to a website, sprottusa.com/rankings, and enters their natural resource portfolios. One caveat, please, natural resource stocks. I don't rank cannabis stocks or supermarkets. I'll rank them 1 to 10, 1 being best, 10 being worst, and I'll comment on individual issues where I think my comments have value. In addition, I will, upon request, the request simply meaning the word charts, I will include the Barron's Gold Mining Index, which is the best pictorial of the gold equities market that I know, and a 100-year commodity chart, which will substantiate my claim that commodities are at historic lows relative to other classes when viewed against the general economy for the last 100 years. Once again, sprottusa.com/rankings.
We'll put a link to that in the description of this video. I'll also put a banner on the screen so people have a visibility of that. Also, folks, if you don't want to lose track of us and get a fresh announcement of this and every other interview we do together with all the description, the links from all of the guests, make sure you go to libertyandfinance.com, look over in the left-hand margin, and you'll see where you can put your email address and your name, and we'll get you on our email list. It's all free, and you won't miss out on any of our videos or any of the special offers from our guests. Rick, thank you once again for joining us here on Liberty and Finance.
Dunnigan, always a pleasure. Thank you.
If you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com, and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs so that you can either begin or increase your acquisition of physical precious metals now and protect your family's future starting today. To acquire gold and silver, just go to libertyandfinance.com. When the main site comes up, click on Bullion Sales. That's libertyandfinance.com, Bullion Sales. You'll see my name, Dunnigan Kaiser, my phone number, and my associate, Kaiser Johnson, his phone number, our email, libertyandfinance@protonmail.com.